Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why U.S. vacationers plan to increase travel spending in 2025.
Plus, we'll break down why Micron Technology's revenue forecast missed analyst projections.
But first, we begin with earnings from the biopharmaceutical company Pfizer.
This week, Pfizer forecasted 2025 sales and earnings in line with analyst projections.
It's a step towards offering relief to weary investors that feel the drug maker is being mismanaged.
For more, we are joined by Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals. And we first asked Sam about Pfizer's guidance for investors.
Look, this is the story about a company that didn't disappoint. I think having seen what happened during 2024, this is a company that people were a bit worried about. You know, is it going to come out and give us a whole bunch of guidance that is actually below consensus? And here we are with something that's in line with consensus pretty much mostly. Mm-hmm. There are some moving parts that's you need to think about if you want to get into the nitty-gritty. But at the end of the day, it's pretty much in line with consensus, and that's a sigh of relief for a stock that's pretty much close to, I don't know if it's an all-time low, because this company's been around for a long time, but it certainly is a very weak share price compared to where it's been before, especially in the height of the pandemic with COVID sales and everybody thinking it's going to be a $100 billion market a year. So that's where we are.
Speaking of vaccines for a second, we were watching the Patrick Stewart Scrooge movie. We like to do Christmas movies, and my daughter goes, "When was this set? Like in the 80s?"
Right.
So to the point we're like, "No, honey, like it was a long time ago, and we would all be dead at this point if we lived in that time." Okay. Yeah. But I guess my question is, how do we have conviction on what these stocks are going to do next year when we have no idea what the administration is going to be like, or what their relationship with drug companies is going to be like?
Yeah, but Alex, the government can't change things overnight, right? So by the time they take office, by the time they start putting new laws into play, which of course one of them is now possibly going to be some way of trying to rein in the PBMs, the pharmacy benefit managers, the middlemen who take the big fat chunk of profit out of these high drug prices. By the time that happens, it'll be 2026 or something like that. The reality is that it's all going to be about rhetoric, right? So are we going to have a Health and Human Services run by RFK anti-vaccine? Is he going to tone down his anti-vaccine? Is he going to get confirmed? So it's going to be all about the optics of it, and it's also all about the rhetoric. No real impact, but investors don't look at what's happening next year. They always look at 2 or 3 years down the road. Now, here we have a company that's dealing with IRA. I think it's the first pharma company that's put out their guidance, and they're saying that the changes in the IRA, which are good for patients, by the way, I have to say that right up front, is going to hit them about $1 to $1.5 billion. I think the number, $1 billion. So 1.5% hit, right? So that's because they're going to be having to cover the catastrophic pay that in terms of the Part D Medicare coverage, and of course they've got drugs that are high priced. So that sort of thing I do expect, and of course sentiment is all in our world. So it just tells you where we are in some of these names.
One of the great new functions on the Bloomberg terminal is MODL for financial models, and this is where Bloomberg Intelligence and Bloomberg have compiled a lot of the earnings estimate models from a lot of the leading Wall Street analysts. And what you see there is, for a company like Pfizer, they got a lot of drugs, and investors really focus on the various drugs and how they're growing. What do you focus on for Pfizer, Sam?
Yeah, so Pfizer's 2025 is about execution and getting this new company that they bought, Seagen. It's not that new anymore. It's a while ago that they bought it, fully integrated and managing those costs. If you think about it, a lot of what they've said today with regards to the growth on the EPS line is due to managing costs. So they've come below some Wall Street expectations in terms of sales and marketing costs, and within even R&D costs. So, but that's been the case. This is a company that's trying to find its new world in the new world of COVID. How much vaccine am I going to sell? How much Paxlovid am I going to sell? Remember, that's a $9 billion line or so, right? That's not a, for a company that's guiding to 61 to 60, whatever the number is here, $61 to $64 billion sales range. So that's where there was a lot of sensitivity and worry. And of course, they've said, I think we're on a straight line from last year to 2024 to 2025. So that's where the worry was. And frankly, new drugs and stuff, it's always important, but we need to see the data to come through.
Our thanks to Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst.
We move next to commercial real estate. This week, we focus on a story titled Office Real Estate is Facing a Year of Reckoning in 2025.
You can find the story on Bloomberg.com and The Terminal. It discusses how commercial real estate is bracing for losses in 2025 as lenders run out of patience and borrowers struggle to refinance loans.
For more, we are joined by Patrick Clark, Bloomberg Real Estate Reporter. And we first asked him why commercial real estate may suffer next year.
These things take time. It's like a slow grind down, just in the way that post-GFC, the delinquencies and defaults really didn't spike or didn't peak until 2012. It takes time for this stuff to work its way through the system. Everyone's running out of patience a bit, like on the lender side. The extensions no longer come free, and they might not come at all at this point. So part of it is that I think the one thing that's changed is a year ago, people might have expected we were going to get 6 or 7 rate cuts this year. And now that, those, not only did those not happen, but we don't expect them next year later. So you can no longer sit there hoping and expecting that interest rates are going to save you. So you kind of got to make a decision.
So how does this come about? Is it in terms of, oh my goodness, the equity folks have to write down the value of the building? That not only, or usually happens when I've got a loan coming due and I've got to renegotiate it, and then I've got to get a determination of the value of the building, or the lender will put a valuation of the building. Is that typically the precipitating factor?
Yeah, I think it's, it's the maturity wall. As it comes time, you have to pay off. There's a big, almost all of these loans have big balloon payments at the end of them, and you got to pay them off. That means you got to get a new loan. And the new loans have not really been available, and or certainly not available at pricing that would be tolerable. And so that's where the negotiations come in, and I think the way those negotiations have played out over the last 18 months have been, let's kick the can down the road. Extend and pretend, or sometimes the cleaned up version of that is amend and pretend, which means you actually had to put something in to get the extension. But again, it's like the extensions are a little. They become harder and harder to get over time, particularly as this hope that there's going to be an event which makes all the problems go away and dissipates.
When is the maturity wall sort of coming up? And I appreciate it's probably property by property. And who takes the hit?
The maturity wall is, it's permeable, right? Things pass through it. In some ways, there's the one thing that happens when you extend loans is that you add them to next year's maturity wall, and so the more loans don't pay off. And I saw a stat, I don't think we got into the story, but something like, it's only like a quarter of central business district office buildings that are financed in the CMBS market have paid off at maturity over the last 3 or 4 years. So it's like a lot of them are pushing out. They're pushing out, and that just makes the maturity wall go higher. Now, they can continue to be pushed out until they can't, and we don't know exactly when that moment will hit, or with what force, or with what volume.
Right. A sprinkle of companies are coming saying we're getting people back 5 days a week. And I wonder if that's being perceived by the commercial real estate market as, all right, maybe the worst is behind us in terms of vacancies and that kind of thing. Is there any discussion in the real estate business that maybe just the business fundamentals have bottomed?
I think, yeah, sure, yes. But in some ways, I think that is more of a catalyst for resolution of these situations. Is sort of like, we know what it is now.
Yep.
It's not great. It's great if you own one Vanderbilt or a brand new high tech office building, 731 Lex. But if you own commodity office in the Garment District or something, that's what it is now, and it's not great.
Right.
I'm just wondering, is it big banks that have a lot of these loans? Is it small guys? Like, where do we see the ripples?
Well, I think that one of the things that I think we've seen happen is that the bigger banks that are in better situations across their business have been able to and have been reserving at a faster, at a higher rate. So they are, they've been quicker to acknowledge the issues and to prepare themselves to ultimately realize losses, whereas smaller banks, we've seen much less of that. We're starting to see smaller regional banks modify loans at a greater pace, which again, I think we see as like they are pretending less. They're extending and pretending less. No. They're pretending less anyway. Like they're acknowledging, yes, okay, like more stuff is still yet to happen. We can't just push these things out. We have to get ourselves in position. But nobody wants this all to happen at once, right? I mean, it's in everyone's interest for these problems to be realized, gradually and at a pace where they can kind of be controlled.
Our thanks to Patrick Clark, Bloomberg Real Estate Reporter.
Coming up, we're going to dig deeper into a retirement crunch that's haunting Americans nearing 60 years old.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to the travel and leisure sector. According to a Bloomberg Intelligence survey, U.S. vacationers plan to increase travel spending in 2025 from last year.
And for more on this research, we were joined by Jody Lurie, Bloomberg Intelligence Credit Analyst.
We first asked Jody to walk us through some of these findings from her survey.
I have to say, as a credit analyst, and I've mentioned this a few times on your show, we get uncomfortable with the amount of optimism. I was uncomfortable personally because we did our credit outlook, and it was a bit too optimistic for my liking. That said, the data doesn't lie. And when we surveyed vacationers, 72% said that they're willing to spend more in 25 versus 24. Now you compare that to last year, where it was only 67% said they were planning to spend more in 24 over 23. So it's a pretty big bump.
Where are they spending it? How are they spending it?
Sure. So, Paul, I mean, I think if you think of the average person, going on vacation is a big thing. We zeroed in on people who are planning vacation as a priority for next year. And for those people, they are actually saying 79% are saying that they're spending more on travel over clothing. And that was compared to 70% last year. Now, where they're going is also interesting because we saw a big spike in vacationers who are planning on going on cruises, that's 37%, as well as on all-inclusive vacations. And we did see a pullback in theme parks. We saw a pullback in casinos and racetracks. Wow. And so what we're seeing is a lot of, I guess, set it and forget it type vacations where people can do these big, luxurious things, and also in hot places like the Caribbean, Italy, or Mexico.
Oh, that's interesting. And also then in terms of budget, like you said, set it and forget it. Like you get the budget and it's done. Like you know exactly how much you're going to pay and you don't have to think about it. That's quite interesting. What's taken a hit? Like you mentioned, maybe where they're not spending money as much.
Right. So I think what we're a little bit concerned about, Alex, and we've been expressing this for quite a few months now, is in theme parks. You know, theme parks had a very good run in 2022. And the question is, are they going to see that same run in 2025? And so far, the data is saying no. It's a little bit hard to say, but I would suspect that a lot of people are getting sticker shock for the destination theme parks. And then the regional theme parks, of course, you know, we had the big merger between Six Flags and Cedar Fair. We, of course, have United Parks, formerly SeaWorld. And I don't know if people are necessarily either counting that as a vacation because they're a one-day trip, or if they're choosing, instead of doing these one-day trips, to do these big, lavish vacations, and that's where their budget is going.
That's interesting.
How about Europe? Because You hear stories about how Europe was just overrun by American tourists over the last several years, and I have to admit, September is my Europe. That's our new thing. So we're doing Europe in September. Last year we did Ireland. This year I think we're going to do Italy, confirming that tomorrow with Kelly with Hawaii. Talk to us about Europe. Are Americans still going to Europe? Because, I got the euro at almost parity.
Oh, yeah.
Paul, you are going to be one of many people going to Italy next year, it seems. We had a big bump from last year. So people who are going to Italy last year, it was only about 18%, and now it's 25% of our vacationers. So that's a pretty big spike. Now, putting it into context, Italy isn't quite back to where it was pre-pandemic in terms of vacationers or travelers into Italy, but they are getting there. What we are seeing is, Mexico, the Caribbean, it's very, very high, and it's going to get higher. Places like Italy, Portugal, Spain, those are going to do very well next year too. Whether or not we get back to pre-pandemic levels for some of those countries remains to be seen, but you might see that you're a little bit crowded, Paul, and perhaps the government of those countries, they've been talking about limiting cruise lines, for example, in terms of docking. And so,
interesting.
It might be a little bit harder to get there. You might have to be a little bit more creative.
I'm going in September.
Yeah, he's going in September. He doesn't have kids
Yeah,
in
you'll
school.
be fine.
Like, he's
Yeah.
good
September,
to go.
you'll be fine.
I'm the one with the
Yeah.
problem.
Yes.
I'm planning a Scotland trip in July. That's going to be something. So,
Yeah,
okay,
yeah.
so let's talk about individual companies. So you're a credit analyst. Which kind of companies are going to win from this?
We're suspecting that Royal Caribbean and Carnival in particular are going to do quite well from this. You could also say a Viking would do well because the smaller vessel cruise ships are going to be able to access these small islands in the Mediterranean. But companies that also could potentially do well, we think, is something like a Marriott or a Hyatt in terms of, publicly traded companies, I should say. And the reason being is, Hyatt, for example, they bought Apple Leisure in 2021, and that gave them a bigger footprint into Mexico, into the Caribbean. These companies have been focusing a lot of their dollars on the Caribbean. But also something interesting is Marriott announced an acquisition of a company that focuses on wilderness and sort of these natural cabin type places. So really, really getting a big kind of mix of things. Competition with, I guess you could say, the Airbnb or the outpost Airbnbs. And we are seeing that a lot of people are preferring domestic vacations next year. It's spiking to 98% are planning on going on domestic vacation versus 96, I believe it was last year. And international is staying flat at about 78%. So people are looking domestic. We might see more national park spending or national park visits than we saw, and Marriott's taking advantage of that.
Our thanks to Jody Lurie, Bloomberg Intelligence Credit Analyst.
We move next to a Bloomberg Big Take story we focused on this week titled Need to Grind, Retirement Crunch Haunts Americans Nearing 60. You can find it on Bloomberg.com and the terminal.
The story looks at how Generation X faces significant financial stress as they approach retirement age, with many feeling they won't be able to afford to retire comfortably.
For more, we are joined by one of the story's authors, Suzanne Woolley, Bloomberg Personal Finance Reporter. We first asked Suzanne to break down what she found in her reporting.
Yeah, there's a lot of stress about it because, as the oldest Xers become 60, they were sort of the guinea pigs for 401ks. The boomers had pensions, and, and the 401k on top of that. And now the Xers are sort of looking at their balances and looking at the news about maybe Social Security having to be reformed within the next decade, and looking at the money that they're spending supporting their adult children and possibly also their aging parents. And it's just leading to a lot of concern about how the heck are you going to be able to retire in comfort anytime soon?
Right, so I was struck by, was it 43% say they can't afford to retire at 65? That is staggering.
It is staggering. It's just a combination of a lot of things. Housing affordability has been an issue. The high cost of living is an issue. These are sort of the peak earning years for a lot of Xers, and they're hit with the pandemic, which a lot of them say was a big blow to their savings. And then just the cost of groceries, the cost of housing, everything has been going up and up and up, and it's harder to save, and it's harder to see how you eke more out of an already stretched budget to put away more for retirement. So
is the expectation that since we're living longer, we're just going to have to work longer?
I think that's part of it, yes, because Xers are obviously going to live longer. The truth is really that a lot of people, at least boomers, have a lot of challenges when they retire. They feel sort of rootless. So in a way, maybe it's not so bad if we can work longer. There's this epidemic of loneliness in America. It gives people a sense of purpose. But the fact is, you want to have the option to retire when you want to.
Or to work differently, right? So maybe
Exactly.
you're working part-time, or maybe you're working at a job that you work maybe 8 hours a day versus like 14 hours, it's a different kind of environment and pace. Like Paul wants to be a Walmart greeter in his third career. Like I'm not entirely kidding about that, but we don't support that part.
No. I mean, but that is sort of the reality. In your later years, you may not want to grind away at the same job you've been doing for, the past couple of decades, but you might do consulting in your area.
Sure.
Or, at least you'll make some money later in life. It's not just like you'll turn the switch at 62 or 65 and then all income coming into you is over. But I mean, Social Security makes people a lot nervous because that's something, it's sort of the one thing in our society we can sort of depend on. And something's going to happen.
What is the feeling in with your reporting here about Social Security? I mean, it's not good. It's not good, Paul. People are really not feeling that Social Security is going to be there for them in the way they need it. And, unsurprisingly, they place a lot of blame on that in politicians.
I mean, I'm Gen X, and I'm assuming I'm not getting Social Security. If I do, that's super. Benefit, go me. But that would be like extra stuff. So like my whole life is revolved around how do I put my money in a way that will make me money later in some kind of tax-free way, because that I've seen with my parents how difficult it is to pay taxes when you don't have any income except for like a pension or Social Security.
Yes, and for most people, 85% of the Social Security benefits are taxed, which is
bananas.
Exactly. Yeah.
That's just my personal feeling.
Yes. I like that formal assessment there. Bananas.
Yeah. So what's the solution?
I mean, there are a lot of ways you can obviously you can, if you're over 50, you can contribute more to your 401k. You can contribute an extra $7,500 a year if you have it this coming year. There are ways to, increase your savings. There are, side hustles. It's really hard to come up with an answer to that question because it's different for every person, what they can do. I guess just like smarter savings and making sure you're doing everything you can to optimize your tax advantage savings with your 401k, and maybe, Roths are something I think younger people should really look into.
Our thanks to Suzanne Woolley, Bloomberg Personal Finance Reporter.
Coming up, we're going to break down some of the challenges that could be faced by President-elect Donald Trump's nominee for Treasury Secretary.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move next to the semiconductor company Micron Technology.
This week, the largest U.S. maker of computer memory chips gave a revenue forecast that missed analyst projections by about $1 billion.
The company was hurt by sluggish demand for smartphones and personal computers. So for more, we are joined by Jake Silverman, Bloomberg Intelligence Semiconductor Analyst.
We first asked Jake for his take on Micron's earnings results.
Yeah, it seems like there might be a trough in fiscal 2Q, which is next quarter. It will kind of depend. There was an inventory buildup, so it kind of depends on how fast those inventories deplete, because while demand isn't particularly strong, it might be kind of weak, it is somewhat stable for the most part. So in terms of unit demand, when we think about end markets, smartphones doing a little bit better, PCs definitely doing a little bit weaker. But on the other hand, as we think about the second half of the calendar year, we might see seasonal demand pickup. We might also see some content expansion opportunities for Micron when we think about AI smartphones and AI PCs. We're not exactly sure what the demand will look like yet. There is, we do believe that there will be some uplift from that.
So is Micron a company that does have an AI angle, doesn't have but would like to develop one? How do you guys think about it? How does the street think?
Actually, if you look at their data center revenue, a lot of that is coming from AI right now. So they have a number of different products that are actually benefiting from AI. I think the one talked about the most is high bandwidth memory, but that's still very nascent. We think it's only going to be about 10% or so of sales, maybe a little bit more now after the recent guidance for next year. So it's pretty early. It's growing off of a low base, but as we take a look at some of the other products, they also have high capacity DIMMs, which are DRAM modules that go into servers. They have LPDDR5, similar style product. And then they have data center SSDs, which slightly different story. We're seeing a little bit of a demand moderation right now, so things are maybe cooling off but could re-energize later in the year.
So that's what I'm wondering. Do you feel like the stock reaction then is overdone based on their AI potential?
I think right now it's just expectations were pretty high.
Okay.
A lot of it was based on AI. I don't think there was a particularly strong expectation for traditional markets, but at the same time, the weakness in those markets was more pronounced than expected. And so you're starting to see this sell-off. High bandwidth memory really hasn't quite inflected yet. So we're not really seeing those results. We're not really seeing that in their results yet.
How much of this is a sector issue, PCs, handsets versus a Micron issue? Because I like this story, and it's like back in the day when I was actually running some money there, I'd be like, take a look at this name here in this pullback today.
Yeah, look, I mean, again, I think it'll come down to how much traditional demand sort of reemerges in the second half of the year, how much seasonality really exists. I think there are a few catalysts to re-energize that, one of those being PC refresh cycle. There's also been a push towards more premium tier mix of smartphones, people upgrading, say, from just the iPhone 15 to the iPhone 16 Pro Max.
Or the iPhone 12, but whatever. That's called. Not me. I'm not that
Actually,
lame.
I do have an iPhone 12, so
you do?
I do need to
I can throw
upgrade
shade. Where does, this is a supremely silly question, but where does Micron sit in the AI world? Like, their customers are who? They get product from whom?
Yeah, so some of their customers include NVIDIA. They now have 3 high bandwidth memory customers. I think one of them is AMD, and another one might be Google, given that they have such high demand for their TPU. And that's partially internally. But they also, that's for high bandwidth memory, but then also some of their other products that I mentioned before, like LPDDR5, their high capacity DIMMs, those are being sold into AI servers as well. But then, you have to keep in mind that some of that revenue, in fact, the majority of that revenue right now is coming from the traditional compute side. If you think about servers that are based on the Intel and AMD CPUs.
All right, thanks to Jake Silverman, Bloomberg Intelligence Semiconductor Analyst.
We turn now to a Bloomberg Big Take story we focused on this week titled Debt Risks That Lured Bessent to U.S. Treasury Now Loom Large.
You can find it on Bloomberg.com and the terminal, and the story looks at Scott Bessent, President-elect Donald Trump's nominee for Treasury Secretary.
The story focuses on how Bessent faces the challenge of reducing the U.S. federal deficit, which is projected to exceed 6% of GDP in 2025.
For more, we are joined by one of the story's authors, Viktoria Dendidrou, Bloomberg US Treasury Reporter.
We first asked Viktoria to break down some of the findings from her story.
What we were trying to show is that the debt outlook, a lot of experts say it looks quite challenging, and Scott Bessent, if and when not confirmed as Treasury Secretary, is going to have to deal with the challenges that the outlook poses while also trying to execute the Trump administration's economic vision. And he himself has spoken about the fiscal outlook in the past. He said he wants to bring the deficit down to 3%, essentially halving it. So we basically take a look at how possible that is, how budget and markets experts think, how likely that is based on, like you said, the drivers of the deficit. Like, for instance, interest cost has become a key driver, particularly in the year that just passed. So it's, all of the experts, or most of the ones we spoke to, talk about how halving it to 3% will be quite tricky.
So the U.S. government's debt load, just to put a nice round number on it, is now over $28 trillion. I don't know, it seems like a big number to me. Is there political willpower on either side of the aisle, Viktoria? Have you learned to address this at all?
Well, it's tricky because, the new administration, they're going to have to face this issue quite early on. Obviously, the tax cuts that expire at the end of next year are going to be a very big part of the debate. And Donald Trump and his administration have said they want to extend those. That obviously means that a source of revenue is not going to be there if the tax cuts are extended. They do think that that's going to boost the economy in a way that's going to reduce the deficit, so that could help. But it's hard to know. I mean, there are fiscal hawks in Congress right now. The Republicans, they control the House. So on the one hand, it could be that it's easier for them to pass legislation, but it is a very thin majority. So it could mean that actually congressional deal making, when it comes to the fiscal issues, is going to be much harder than it looks.
And not only is it 28 trillion. That's up from 17 trillion or less at the end of 2019.
Oh boy.
And as a share of GDP, debt's on a trajectory to exceed even World War II levels. The idea is that you get these blowouts when you have a war because you need to fund it. We're not at war in the same kind of way, and that's part of the issue. Talk to me about issuance. We've seen Janet Yellen, Treasury Secretary, issue a lot on bills. Do we think Scott Bessent is going to do more on the long end or going to stay on the bill side?
Well, that is a great question, and that's one a lot of market participants are going to be looking to get hints or answers to. I think when we talk about the U.S. debt load and issuance, I don't think anyone is saying that the U.S. is not going to be able to find buyers for its debt. But as we saw last fall, when yields were up, it could get a bit more expensive for the U.S. to borrow. So that is a consideration because it weighs so much on the overall spending of the government. In terms of Scott Bessent, we don't have too many clues yet as to how he would proceed with issuance. But what we know is that he was critical of the current treasuries and of Janet Yellen's treasuries strategy to issue more on the shorter end of the curve, which was, at a time when yields were very high. So I think part of that strategy was to, essentially weather the higher interests at the time. So if we're going by what Scott Bessent has said or other people in the kind of Trump economic orbit, we could see a shift in focus to longer treasuries. But it's always different, experts tell us, when secretaries actually become secretaries and they deal with kind of a more holistic view of how issuance works and the feedback they get from markets as well, which is very critical to this.
Our thanks to Viktoria Dendidrou, Bloomberg US Treasury Reporter. We move next to M&A. The impact of U.S. elections reverberated across sectors and geographies with respect to M&A in November.
And a crucial catalyst for much of the deal-making globally is future tariffs. This is according to research from Bloomberg Intelligence.
And for more on this, we were joined by Andrew Silverman, Bloomberg Intelligence Senior Policy Analyst.
We first asked Andrew what his expectations are for M&A in 2025.
So it's actually really interesting. For the past year, we've seen basically the same pattern month after month. We've had tech companies being acquired. That's sort of like the leading target tech companies. And then we have financial companies, and then normally in the third place we see traditional energy companies, right? But in November we saw this really interesting development. We saw a big spike in basic materials companies being acquired, and we also saw this increase in telecom companies being acquired, and we saw an increase in media companies, obviously, earlier in December. And I think that companies are positioning themselves after they saw what happened in the election, trying to proactively protect themselves for what might come in a Trump presidency.
Do we think that these will be transformative monster deals? Or are we talking like small bolt-ons?
Oh yeah, these are big deals.
Okay.
Like OneOak, for example, it's an $8.7 billion deal for Enlink. Now that's a traditional energy deal. It's sort of it's interesting. Companies are coming up with different sorts of conclusions about what's going to happen in the Trump presidency. We see these sort of traditional energy companies still doing these big acquisitions, but then BlackRock did an acquisition of HPS investment company, and that company is a big credit investor in clean energy. So obviously they think that either the Republicans aren't going to be as hard on clean energy companies as people might think, or maybe even they're going to be good for clean energy companies. Obviously, if he puts tariffs on foreign investment in the United States, then clean energy is a place where we might see a lot of it, because a lot of the batteries and a lot of the solar cells and the even the minerals that we use in our batteries are coming from China. So if it puts a 60% tariff on China, not so great for clean energy.
Yeah, another reason to maybe get some deals done now before the tariffs kind of muddy up the situation, perhaps. I remember Paul Taubman, one of the leading M&A bankers on Wall Street, formerly of Morgan Stanley, now he has his own firm. He's out there saying they're hiring investment bankers now in anticipation of deal activity really picking up. One of the areas I think should be better is just the regulatory environment. It seems every time over the last 3, 4, 5 years that we saw a deal announced, big deals, the Federal Trade Commission would have a problem. The Department of Justice would have a problem. Now I think the expectation is that's going to ease up a little bit. Is that what you're hearing out there?
Well, certainly with Lena Khan gone, I think that's the single most important factor.
Because she's head of the FTC, right?
Right, FTC,
okay,
exactly.
And very tough on consolidation.
Yeah, actually, Jen Rhee and I have done some research on this, and we think that the perception is that it's going to be a much better environment for M&A, but not so fast, because there's also that strong populist stream to the Trump administration. In fact, his vice president, J.D. Vance, is a big fan of sort of some of these progressive pieces of legislation that are trying to make, S&P 500 companies taxable when they do reorganization. So it's possible that even though people are very sort of optimistic about what the environment is going to be without Lena Khan, for example, it might not be as spectacular as they think.
Our thanks to Andrew Silverman, Bloomberg Intelligence Senior Policy Analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.